it's Poku Banks, baby. Welcome back to my channel, MMO gang. Let's get it. Now, I'm a 9-year-old entrepreneur that loves talking about personal finance and entrepreneurship. In this video today, we're going to be talking about the easiest way to become a millionaire, the easiest way to get rich. It's pretty simple. It's simply index fund investing. Let me explain to you. Before we start, shout out to Dreamers Apparel. As you can see here, they sent me a top. I think it looks pretty good. I like the shape, I like the design. Yeah, make sure you just check it down below in the description. So when it comes to index fund investing, this can be automated. It's very low risk, so there's little to no chance of you losing any sort of money. You don't need any huge amounts of brain power. You don't need to be creative, or you don't need to even create the next Facebook or Snapchat to become a millionaire. Big disclaimer, I'm not a financial advisor. I'm not an investment advisor. This is all for entertainment purposes only. Now let me just get something straight. You may be thinking, Poku, you're 19 years old, you go to university, and you're not a millionaire, and you're telling me how to become a millionaire. Why should I listen to you? Allow me to explain. Look, I'll be real to you. All the information that I'm about to tell you is regurgitated information from wise investors like Warren Buffett. More information coming from books I've read, so like The Millionaire Next Door, Rich Dad Poor Dad, and everything that I'm about to state is backed up by statistics ranging from over 100 years ago. All I'm simply doing is passing the message from these investors to you guys. I'm the middleman. Look guys, investing is pretty simple, there's no need to do anything crazy, there's no need to reinvent the wheel. A lot of people may ask me, oh, Poku, some stuff you say is a little bit repetitive. It's supposed to be repetitive, there's nothing new. Investing is pretty old, by the way. Finance is a very old subject. The fundamentals don't change. Yes, you may update it with new things like cryptocurrency and all these new things to invest into, but finance in general is old. The same things apply. Compound interest has been around for time, it's one of the 8th wonders of the world. It's the same. All you have to do is study and listen to people at the top and you'll be fine, literally. Alright, cool. So for those that don't know, what is the stock market? The stock market is essentially a place where buyers and sellers can trade securities, which are stocks, ETFs, mutual funds, and bonds. There are thousands of companies listed on the stock market on different exchanges. So there's some in the New York Exchange, there's some in the NASDAQ, there's also some in the London Stock Exchange, and there's more across the world. Just remember this, when you buy a share of a company, you're buying a piece of that business. Alright, cool. So what's the index fund, Poku? An index fund is essentially a fund that tracks a benchmark like the S&P 500. And the S&P 500 is an index which tracks the largest 500 publicly traded companies in the US, which is essentially 80% of the total US market value. Now to make things easier to understand, let's compare the S&P 500 to chocolate, for example. We've got, Amazon, Nike, Tesla, Walmart, Apple. These are individual stocks. You can compare these to buying individual chocolates. So we're talking Mars Bar, Maltesers, Galaxy, Milky Way, Bounty, all of these chocolates, they're all individual chocolates. Now the S&P 500 is the same as buying Celebrations. Celebrations in general is a good chocolate box because it has all the little different stocks, all the little different chocolates inside of it. Buying the S&P 500 is now getting a little bit of every single stock. So when you buy an index that tracks the S&P 500, you're not only just buying into Apple, Disney, Netflix, you're buying into those 3 companies and 497 more. As well as 500 individual companies in different sectors, different industries, this will bring you more diversification benefits and it will give you a more broad exposure to the market. For example, let's say if Amazon or Tesla had a bad day in the stock market, the individual stock could go down a lot, but the S&P 500 won't go down too much. Why? Because there's only 1 out of 500 companies in the index that is tracking. But then this also works vice versa. So say if Amazon or Tesla had a very good day, yes, the S&P 500 will go up, but it won't go as much as the individual stock. And this may also be because other companies in the S&P 500 may have went down, so it just balances out. If you know absolutely nothing about the stock market, then you can just put your money into this index fund and you'll be safe. And now the reason I say you'll be safe by investing in the S&P 500 is simply that there's little to no chance of it going down to zero. Right now it's currently trading, at the time of this video, $3,400. If the S&P 500 went all the way down to zero, that would mean all the companies that you know and love, so Apple, McDonald's, Amazon, would also be going down to zero. This will mean there will be total anarchy. What could happen for all the companies to go down to zero? There will have to be some sort of zombie apocalypse or aliens will have to come, something crazy. So if the S&P 500 really did go down to zero, that would be the least of your worries. Yes, it could go down in value, but for it to go down to zero, unlikely. Now what you need to remember is that the wealthiest investor alive, Warren Buffett, he said that for most people, the best thing for them to do is to own the S&P 500 index fund. The average annualized return for the S&P 500 over the last 90 years is 9.8%. This means that maybe in some years it might have went down -3%, some years it might be in +30%, but over the last 90 years on average, 9.8%. So this is what we normally use in our calculations. Now the investors use the S&P 500 results as a benchmark. So essentially, in any given year, if you can make a bigger return than what the S&P 500 brought, that means you've actually beaten the market. Let's say the S&P 500 returns of 7% in a year. If you make 12% on your money, then that means you've beaten the market. You are a good investor. This is what all hedge funds, all investors try to do by handpicking stocks. They can pick their stocks and they believe that these stocks will make even bigger returns. So essentially, let me give you a basic example. If you have £100, the S&P 500, if you invested that into an index fund, you'll probably end the year with £110. If you can turn that £100 into £150 by yourself, you've essentially beaten the market. You've done better than what the market's done. Yes, we're playing with lower numbers. It's very easy to turn £100 into £150. Now you need to think of it like this. Can you now turn £100 billion into £150 billion? That's where the difference comes. You may be thinking, Poku, getting 10% of your money, that's easy. I can make a few trades, or I can buy and resell, or I can start a business. Yeah, it's easier you saying that when you have £1,000 to play with. But these guys are playing with billions of pounds. Turning 10 billion into 11 billion is a feat in itself. You're making $1 billion profit. Okay, so just remember, we're playing with big numbers here when we talk about percentages. Now remember, you can study all of the fundamentals, you can read all of the financial reports, and you can still underperform in the market. This is what happens to most investors, most hedge funds. So again, if picking stocks isn't for you, be simple, invest in the S&P 500. So the SP Dow Jones Indices released a report stating that lots of hedge funds are finding it increasingly difficult to keep up with the market, where after 9 years, 64.49% of hedge funds underperformed the market. And after 15 years, 91.6% of hedge funds underperform the market. And this is why I believe a proportion of your total investment portfolio should be in the S&P 500. Yes, you may be thinking, Poku, only 10%, 9%, this isn't exciting. Yes, I'm sorry guys, it's not exciting, This is what investing's supposed to be though. Investing's not really supposed to be fun. It's a long journey essentially. It's a long, boring game. Gambling is fun. Gambling's fun and exciting. Picking stocks, trading forex, all of that is more towards the gambling side of the spectrum. This is investing. Again, if you want a video on the investing spectrum, so here's investing, here's gambling, where do all of these industries, all of these ways of making money land on the spectrum, I'll make that. Just comment it down below so I know there's demand. Alright, so let's get into some numbers. Firstly, since we're using an annualized average return of 9.8%, let's take away 2% for inflation. The government aims for 2% inflation, so let's just take away 2%, so we've got 7.8%. If you were to invest £250 every month for 45 years, so let's say, you start investing at 20 years old, 45 years later, you're 65, retirement age. You would have 1.1 million, and the beautiful thing about that is that only £145,000 will be of your money. The other 900,000, that's literally compound interest. That's the power of letting things go. That's the power of investing in something, holding it, and forgetting about it. Just do it automatically. If you were to do the same with £350, but in 40 years, so from 20 to 60, you have $1 million in your investment portfolio. But guys, don't forget, you'll be increasing the amount of money you invest as your income rises. You won't be investing £250 every month for 45 years. You may start now doing £250 for 45 years. Or in fact, you might even start even less. You might start off simply £50. But as you grow, as you get more income, you'll be investing more of your paycheck. Do you get what I'm saying? Like, even me, they'll get to a point where I'll probably be investing £1,000 at a time. So again, it will just snowball and become even bigger. Okay, so now there's 3 things to look out for when choosing an index fund. Let me explain to you. Number 1, expense ratio. This is essentially the fund management fee for managing the index fund, picking the stocks essentially. But since we're investing in index funds, and as this is passively managed, as there's not much buying and selling that needs to be done, the fees on this, the expense ratio should be extremely low compared to a managed mutual fund, for example, where an actual hedge fund manager is picking the stocks. Also, there needs to be a lot of liquidity. This will affect how fast we can turn our investments into cash. If you were to buy a house, for example, that is not really liquid, If you really needed the money tomorrow, you cannot sell your house tomorrow or overnight. It takes months to sell a house. It's not really liquid. Whereas with stock, literally press the sell button and boom, you got your money into cash. You can withdraw it within 3 to 5 working days. And finally, how well it tracks the indexes. There are plenty of different funds from different platforms. So, there's Vanguard, Fidelity, all sorts, Trading 212. And then there's also different countries. So then, say in the UK, you'll be investing in a different index fund compared to someone in the US. So people in the US invest in VUO. People in the UK will be investing in VUSA, VUSA. So you need to make sure that it tracks it accurately. Now, since most of my audience are EU, UK based, we should all be investing in VUSA. VUSA has an expense ratio of 0.07%. So this means for every £10,000 that you invest, it'll cost you £7 for them to manage it for you, to make sure everything goes smooth, that you can sell it and buy it easy. If you're looking to do this, you can do this on Trading 212, on the Invest account or the ISA account. I recommend the ISA account as there's more tax advantages. If you want a free share from Trading 212, all you need to do is click the link down below in my description, deposit £1, and you'll get a free share. Both of us get a free share, so it works both ways. And then you can invite your other friends and make even more money. And here's some investment strategies that you can use to start investing with index funds. Number one, dollar cost averaging. This basically means you are buying or investing into the stock or ETF or index fund on a weekly, monthly, or any time interval basis. You are doing this continuously, whether the market is up or down. You're literally just buying it, and that's what I'll be doing. It is best that you can automate it. Why? Because, you know, it requires less effort on your behalf. You don't have to remember, you don't have to put in any diary. It'll just be done automatically. That's the best way to do it. If not, you can also put in a lump sum. That also works. So whatever, you know, works for you. But I'll probably be doing a dollar cost averaging route, so putting in money every month. And secondly, just simply hold for as long as possible. Look, I can't lie. This isn't a quick, you know, get rich quick scheme. You know, literally, in 1 year you're only getting 10%. You know, again, 10% of £1,000, you're only making £100 in a year. You need to allow for it to grow and see what compound interest can do with your money. What you need to remember is Warren Buffett made the bulk of his wealth after the ages of 52. He wasn't rich in his 20s, believe it or not. You can check it up, check the biography, check it all up, Google it. I plan on holding my investments for the next 30 years minimum. Yes, if you're buying individual stocks, it's different. You know, you can buy a stock last month, and you can sell it now, you can make a lot of profit. But you know, again, you want to hold it for the long term, guys. You know, we're in this for the long term. We're trying to build wealth. But guys, just remember, before investing, make sure you have an emergency fund of 3 to 6 months and pay off all of your debts before investing. That's the first step. And if you find it hard to get to 3 to 6 months worth of expenses, start with £1,000 as an emergency fund. But yeah guys, I hope you guys enjoy that. If there's any more videos that you want me to do, request it down below. I'll see you guys another day. It's Poku Banks, baby.